Hello guys and girls, welcome back here to Chainlog Market School. This is the YouTube channel. Here I'm going live obviously, and today we'll talk about on-chain, we'll talk about Bitcoin, we'll talk about the market in general and the macro as well. We'll see anyway how it goes. Meanwhile, we are waiting for people to enter here. I'm live. I made my haircut today, so I'm a little bit different. Anyway, let's we're going to see what to talk about today. Let's wait like 5 minutes. Meanwhile, so meanwhile let's get on one chart, for example. So today I'm gonna talk about Bitcoin. Here is the Bitcoin dominance, for example. And if you are on my on the Chainlog Discord, where I post my daily update on Chainlog, for example, we have services for alpha resources to share the alpha around the internet that I found interesting, with reports from VCs, capital ventures, so and even resources like the state of the market, what could happen in 1-2 years, what are specific trends that are unrolling, and more about specific arguments that I found. And also on Chainlog we have the news aggregator that takes all in consideration all the news that are the important ones, so you don't have to go finding it on the internet from 1, 2, 3 or 10 or 20 sites. So that I aggregate all this news to have you a news feed right there. And also we have a daily update that I do, and here this kind of for example, this kind of chart, I am explaining it every day. You see right here I have a cyclical behavior about the dominance. These X are a study case I'm gonna maybe present to you in the next few weeks. I don't know, I'm just studying for now, and so don't take this in consideration right here. So you see that we have a cyclical behavior of the dominance, where we had ups and downs, and every time we touch a low when we got the low on the cyclical behavior, and we touch a high more or less when we have this high on the cyclical behavior. And so I'm waiting it to see where it bottoms, more or less from the end of July and the end of August right here. So we have 1 month to see where it could bottom. And so this is cyclical analysis right here, and I'm not doing today any kind of in-depth about that. It's just a measurement of cyclical behavior that could change in any moment, and until we see this trend breaking down again from last year May, for example, we'll keep saying it bottoming in the cycles right here. So we get an high right here, and this is the supports that are becoming resistance, because we tested it as resistance on the Bitcoin dominance right here, that is at 34% more or less. That is also 0.382 Fibonacci retracement level if we get to when we get upward movements. And also, as you see right here, the bottom could be very well be the last bottom, so we got a double bottom on this dominance, or we could retest this second trend line right here, that is the yellow one, to see if the bottom were in, but probably we're still here on this in this range from 0.382 to 0.236, and this could be a support, and probably if broken we'll retest the last low, but we'll see anyway. I'm expecting this, so probably the altcoins will still overperform Bitcoin in this month or two probably, but to the downside as for the upside. Meanwhile, when we get up, most of the time when we get up, the altcoins, if Bitcoins drops down, obviously, are getting destroyed from the dominance itself, because people just swaps altcoins for Bitcoin, and so the dominance get up, Bitcoins stop getting lower, but altcoins just getting destroyed against their pair with BTC. And we're seeing this trend obviously also on the other dominance. For example, here there is BTC dominance, here is others dominance, and as you see, when we got this uptrend in Bitcoin dominance right here, we had also the others dominance getting break down to previous supports, and we are seeing this again when the dominance is getting down, the others getting up, and this is also part of the ETH dominance that you see when the, for example, I just make an example right here. ETH dominant, when ETH USD, this is my ETH USD graph with a little bit of history. When the weekly 200, let's make here, this is the 200 weekly SMA, for example. When we are above the this weekly SMA, the ETH dominance is reacting better, and so ETH also and altcoins are also reacting better. Meanwhile, we are below this 200 weekly SMA. ETH will still be more weak, and so altcoins, because most likely they'll altcoins move also with ETH dominance. And for dominance itself, I don't know if you have any question. Anyway, if you have any question, you just you can just make a note to me. And anyway, if USDT here, we are taking this into account. When this goes down, most likely the Bitcoin dominance is getting up, because USDT and USDC are entering the market. In the other cases, not. Obviously, they could obviously getting down and getting into alts when Bitcoin dominance is getting down, and so this getting up. And this is just a case that could matter anyway. I would like also today to talk about the 10-year Treasury, okay, and the 2 years Treasury, so the macro environment. But I don't know actually if you would have this kind of speech today, but let's make this let's talk about this a little bit. So here we have the data from the Fed, economic data of St. Louis Fed. This is a tool I use for assessing the overall market, the overall macro economy movements that goes along with the macro market, with the stock market and the crypto markets themselves. As you see, this is 10-year Treasury constant maturity minus 2-year Treasury constant maturity. Why these graphs are important? This graph in particular is important because it is the yield curve you maybe heard about a lot, and in this case we are talking about the movement of the yield of the bonds of 10 years bonds and 2 years bond for the US. Okay, when let's make so you understand what we are watching here. Okay, when 10-year Treasury yield is getting lower, it means that the long-term investors from are not taking are not actually taking into account a risk, an high risk of lending money for 10 years, and so this means that meanwhile the more you lock up your cash in the 10-year Treasury constant maturity, so in the 10-year bonds, the more you should have a return and a yield on that. But if it drops, meanwhile the 2 years that are obviously less risky, okay, because they have 2-year lockup for your money, are getting higher. That means that the overall economy is getting worse, because you have the same amount of risk on the 2 years. So in a shorter period, you have the same amount of risk you have in the 10-year Treasury that you're going to buy. That means so that we are actually in this moment here on this chart, for example, we are more or less at zero. Okay. The very base of this of this graph. That means that the economy is so wrecked that in the 2 years we have the same risk we had to lock up in the 10 years. And as you see right here, every time, and we watch this subtraction right here, because as you see, every time we fell below the zero on the yield curve, so we get an inverse yield curve, this was an anticipation of a recession. Every single time since we started tracking it, it happened. As you see right here, we fell below the zero. This is 1980s, the first 1980s. 1979, 1980s, we were in a recession, we fell below, and we got into a recession. But then the same it could be said for in 2081 we fell below again here, and when we started trending higher on the yield curve, we had a recession. The same here, we fell below, and when we started trending higher, we had a recession. And these gray bars right here in the middle, as you see, are recession. Okay, recessions are actually here drawn with these gray bars, vertical bars. So we got it here at the 2000s, we dropped below, and 2001, 2002 we had a recession. Here 2007 we had a recession. In 2008 here for a little bit in 2020, but before the COVID, obviously in the COVID crash, we had this inverse of the yield curve, and then meanwhile we're getting up, we saw this getting into a recession. So now we are waiting, and every analyst and every economist are waiting for this trend to be seen again, and to see if we fell below of this little fell below we had could come into a recession later on in this year, in the next year. And it's still not an official recession, obviously, but if you watch and you pretend that everything's alright, you are not getting the point of the entire market. And so we're watching this, and we'll see how it goes in the next future. Probably depends on what will come, because this month we have the earnings coming from the majority, the second quarter earnings, the first quarter earnings coming from the major companies, and we'll have it until the end of this month, and we'll see how it goes. But I think we will see a lot of unemployment, the unemployment raising, because you saw most companies fired people, and we'll see maybe also a reduction in earnings, and because people will starting to get out of the market, start getting out of the goods they don't really need. They are most likely buying goods they need. And there is also surveys like this, for example, the University of Michigan Consumer Sentiment, that is a surveys on the financial health of the consumer that goes on from the University of Michigan. You see it's trending lower. At the lowest point, one of the lower points is level B. And so people is concerned about their financial health, obviously, and not only that, but also we have another service right here of the National Federation of Independent Business. Okay, and this is the Business Optimism Index. This tracks the amount of movement in for the business owners, the amount of financial health they see, how much of goods they'll think they buy, what they see the economy, and this curve is flooding right here, but it's still getting lower and lower. So there is no much sentiment. Also, from the very base layer of the economy, the sentiment is very bearish, and not only by that, but also by any other metric. But as you see here, we have civilian unemployment rate. Obviously, this is a rate. This is the rate taking that the Fed taking consideration. But this is the more or less we could call it the core unemployment rate. Why we call the core unemployment rate? Because this is the U3, that is one of the 6 methods the Fed and the Bureau of Labor Statistics takes in consideration to assess the movements of the labor market. And this right here just doesn't take in consideration people, for example, that stopped searching for a job because they don't find it. They don't take in consideration the part-time jobs. They don't take in consideration the majority of the problems the population has. So the actual U6 that takes in consideration all of this is actually at 7.1%. I don't have the graph right here, but I just watched it 1 or 2 days ago, and so the fact here is that we are not seeing this because this is a lagging indicator. It comes in the first Friday of every month, and it comes after the actual firings are actually took place. Okay, so we'll see this obviously getting higher, and while we're this is my opinion, obviously. But why we're watching this? Because the Fed watches this as an indicator of the actual economy that is still strong. Because as you see right here, it's as an historic low value. If you watch it compared to the previous cycle, is an historic low value. Meanwhile, a 10% is an historic very high value. Okay, so they still watching this and saying, well, we have an unemployment rate that is historically low. So that the fact is that we cannot tackle inflation from the rate hikes prospect, because the demand is actually more than supply, and the problems with supply chain issues worsen supply for our citizens. What could we do? We should lower demand to reduce inflation, because a lower demand with a lower supply is actually taking inflation more or less at the same level. And we are seeing now that supply is getting down when demand is still the same as of yesterday, as of last year, for at least for the American people, from the same goods. And so obviously the inflation get higher, because more people are getting that wants the same amount of products that they can't have because of the the China ban or the zero COVID politics they put in place. So the actual lockdowns they have, the ports that are closed, the problems deriving from corn, wheat, from and oil, from Russian sanctions coming from the war in Ukraine as a principle, and droughts that are all over the Europe right now, in Italy too, and also in America we had droughts. We're still in a lot of problems, and so anyway, this is what actually the Fed sees, and covering their eyes, they see we have a strong economy. But the fact is that this is a lagging indicator. Most of them, they are watching most likely this. Okay, this is a macro snapshot right here, and here we watch the same key series. As you see, key series, the FOMC highlights in its summary of economic projection, and this is what the FOMC, so the actual Fed members, are watching in every time they meet each other, and they watch a real gross economic product, real domestic gross domestic product, that is the amount of growth, so the year-over-year change of the gross domestic product, but the real one. So the real one is not the gross domestic product itself, but is adjusted by a deflator that is actually what is a deflator? A deflator is a measurement of the actual inflation perceived, and is not actually as a real number, like could you think about like a smart contract that has the same values. It's just a number that the Bureau of Labor Statistics takes out to make so the actual gross domestic product can be deflate from that index. But you can also see this kind of real inflation. So we have this gross domestic product less the deflator, that should be the inflation, the actual inflation in the gross domestic product, and we have the real gross domestic product, so the gross domestic product less inflation. Even if you can count inflation in different methods with PCE, with CPI, and the different type of CPIs, because there is flexible CPI, there is core CPI, sticky CPI, and there are a lot of different things that I'm not talking today. If you want, anyway, I'm here. You can always ask me those questions. And anyway, as of right now, we are still seeing this real gross domestic product getting a little bit down, and the projection at the end of the year for Q4 2022 are a range high of 2% and a range low of 1%, and this means that with a median of 1.7%, and so the central tendency low of 1.5%. This is the projection at the end of the year for the gross domestic product, real gross domestic product growth. So we'll have a growth in GDP by 2 and 1%. This is the SEP projection, obviously. So the summary of economic projection by the FOMCs, so by the Fed. I don't think we'll get to the 1% low, but probably a little bit less. Anyway, we'll see. Unemployment rate still projected to be at the end of the year to 4 to 3.2%, from 4 to 3.2%. But I think we'll have at least a 4, 5, 6% at the end of the year if the economic condition keeps growing. As you see right here, they watch the unemployment rate, and they see the personal consumption expenditures that are getting higher. So they say this. They see this like an economic strength. Obviously, people are still spend more and more into the economy. But if you take actual PCE, personal consumption expenditures, and you keep out inflation, okay, you see that obviously that you can spend more for less product. Okay, so this is just covering themselves, their eyes, and seeing that probably they are just under pressure from the government to tackle inflation, and they're just covering their eyes, waiting for something to break so they can reverse course. Because it's obvious for me watching these charts that we're not in an economic condition that we could see as strong. Obviously, neither for the U.S. government and economy. There is the core PCE, that is this red line, that is the PCE without food and energy. Meanwhile, PCE is with food and energy, and is projected to lower at the end of the year for the probably it will be in this case, but the projections are most likely always wrong. Like this, for example, the effective federal funds rates, that are the actual rate the banks lend each other money. Okay, to this is a real complex argument to make. I could stay here half an hour explaining how the overnight index swap works. So the overnight lending from the banks and the reserves they have, and so taking into consideration quantitative easing and reserves they have central banks. Just taking consideration that the effective federal funds rates are the rates at which the banks lend each others, okay, borrow and lend each others, and this is projected to be at 3.9, 3.1% in this range at the end of the year, and 3.9% lending through the banks. That means that banks would overcharge the consumers when borrowing to a 5, 6, 7%, and so the average consumer will get to a point it will be able to actually repaying these debts. And this is I think the market is seeing this as a bluff from the Fed itself. In fact, from the last meeting of Jay Powell, the actual S&P, for example, was getting lower, but after the speech it started trending higher, and also the bonds here started getting lower. The bond yields and the US bond yields started getting lower because they priced in the fact that this could be a bluff. It's practically a bluff because you have the neutral fund rates that probably are at 2.5%. Neutral funds rates are those that tackle the economic conditions and make so inflation from the perspective of money printing, from a money printing perspective, are actually lower to zero. So we don't have inflation at that point. They'll keep rising over the neutral funds rate. They're probably getting something destroyed along the way. Something will break, and we'll see about that probably in the next few months. But I think the market priced in their bluff, and somewhere between here and the end of the year, we'll see at least this rate, but not more than that actually. Okay, probably not more than 2.4-2.5% on the effective federal funds rates. And I'm watching closely, obviously, IAE and IEI and IYC here, because this is junk bonds, and as I already made known on Twitter, for example, every time we get lower is in a state of the market that is coming to a recession. These are junk bonds, so corporate bonds that actually yield a lot more than the investor kinds of bonds. So they are rated less than B minus, and most likely BBB or C or less, and so there, every time there is something that goes wrong in the market, speculative assets like this tends to follow a downturn, and that's it. Instead, the 3.37 here Treasury bonds are seeing this kind of event also, but they are still more safer assets than this. And if you take in consideration the actual IEI divided by IYC, you'll get the point. But another metrics and other factors we are taking into account here is the hour worked by full-time and part-time employees. And as you see, this could be another factors to the unemployment rate. And why I'm saying that? I'm saying that because before we're seeing companies firing people, most likely we're seeing people companies just lowering the hours their employees are working. I'm literally exploding here. I have to drink something. I'm trying to not make you see the marks on the bottle. I didn't think about that. I didn't think about that. Anyway, I'll get that out of the way. So reducing the hours worked by full-time and part-time employees is the first sign of a downturn in the UN rate or the unemployment rate. Okay, and then watch it very closely because, as you see, we're keeping getting lower in a monthly trend right here. This is January 20 actually, but you'll see that in the same way we can have this kind of trend when this is just an example we had in the COVID crash, this kind of trend before the actual unemployment rate just got wrecked. Okay, so I'm watching this on these charts right here, but I not have this under hand, and to see if it will happen as I'm watching the job openings, because this, as you see, are there are a lot of job openings. I think that actually there are 2 job openings for every worker seeking job. but there is a mismatch probably, and not only that, but a mismatch of the positions, the type of position openings, and the jobs, the qualified people to take place on those jobs. And this probably will keep increasing in time because we need more and more type of people that schools are not preparing to, because they are late, they are old, and they are not in going at the same pace as the market does, as the world evolves. So we'll probably see a rising of openings and still have a lot of jobs, that cannot be filled. Still, the unemployment rate will never be less than 2 or 1, but I talked about that also on my Twitter, so I'm not taking into account it right like this today. But let's just is going a little. I'm going a little bit too deeper here. Let's just watch something on chain that I wanted to talk about for the Bitcoin market, so the crypto market itself. I'm checking here a chart, as you see, that is taking into account the number of actual profit realized on chain from the more cohorts, like short-term holders and diversified cohorts, divided here as colors. And as I already speak to my chain log every day, and I'm watching it every day, and more metrics, as you see right here, I'm taking this every day into account. In the last few days, I've seen most likely day traders getting a little bit of profit in the upside, but the majority of people that are actually hodling let's get out here the actual short-term orders, and also those that are not taking so much of a profit. As you see right here, long-term holders are not taking very much profit right here, but still there is someone 3 to 4 years that is taking profit along the way, and so the 4 to 8 years, but who they are actually taking profit. And so to respond to this, we are watching the actual address balances. So we have MPEX that has more than 10k coins, we have whales that have 1k to 10k coins, sharks that 100 to 1k coins, etc. You just read it by yourself. And as you see right here, the majority of these people taking profits along the way are coming not from fish, so not from people to 100 bitcoins, nor 1 to 10, nor 0 to 1, not 0.1 or less than 0.1, but most likely from MBEX on the 30-40k range we had. And now these are whales that are actually getting profits along the way, and whales so that are, as I already spoke, 4 to 10 years, 3 to 4 years coins. So they are coming from this kind of range right here on the top. Okay. And this is realized loss distribution instead. Is the same thing, but not profit but loss. So we have a realized loss on chain, so movements of coin on chain at a level that is less than what we're seeing. As you see right here, majority of them are actually short-term holders, 1 day to 1 week, 1 week to 1 month coins, 1 month to 3 month coins. And we saw this spiking, but we have seen also 1 to 2 years, 6 months to 1 years coins being spent at a loss, all the way down since we touched the 30k until now. and that means that people who hodled through this kind of all this kind of price action right here. This is my technical analysis. One of the actually one of the many charts I have for BTC. I actually made this public in a Twitter post last month, I think, and as you see right here, here we are 2 years ago. So people were still in. I'm talking about this later. Here, people are into 1 to 2 year or 6 months, 1 month. Are actually those in yellow and green, and are those who are in with the short-term holders are actually selling at a loss. And we could see it that who are those 1 to 2 years that are selling at a loss is not plankton, because they are keep stacking, not shrimps, not crabs, not fish. They're most likely sharks, whales, and humpbacks that are selling at a loss at these ranges right here. Okay, so still is not a good. Obviously, is not good to see that in a prolonged way, but still is not so much important. We have still the base, the real base layer is just keeping stacking sats, and that's the most important things. And when these side pressures coming from these macroeconomics movements will fade out of the market, we'll have this continuous uptrend that we are seeing from years and years from people who are stacking sats, who are getting more bitcoins, and at the end of the tunnel we'll see the light again. As always in bear market, instead we are seeing this kind of behavior from those who have a lot of monies and have to cover themselves from loans they got over leveraged. And we are talking about not only by whales itself, but also with protocols. We are talking about protocols like Celsius, like Voyagers, Ventures Capitals like FreeAC, that are getting liquidated, and their assets are getting moved on chain, obviously at a loss. And they are obviously the sharks, the whales, the humpbacks that are actually selling the most in these periods, because they are fleshed out. They have to sell their coins to cover up their debts. And this is not very important, as I said, because we are not seeing this kind of behavior coming from long-term holders in a consistent manner. The realized loss is just from people who 1 to 2 years, 6 months to 1 year, people who just saw the top, the bull market, and they haven't experienced yet bear market, as instead we holders of the last cycles do have. And so this is just a normal behavior in my perspective. Watching on chain like this is just another metrics I wanna make you know about. The average spent coin, actually the average spent output lifespan or average spent coin age. This is misleading in my perspective, in my opinion, because the average spent output lifespan is actually taking consideration the UTXO and not the actual coin volume. So this metric is ponderated by a UTXO, and so let's make an example of a UTXO. It's like a bill, okay? It's a $5 bill and a $10 bill that you go to the grocery store and you exchange for the goods. Are just one bill of $5 and one bill of $10 or $100 or whatever. It's have the same weight on this metric. So as you see, there are a lot of UTXO, a lot of bills being moved on chain, but we can see that this is obviously an high on this metric, a really high measure compared to the last few years. but also we can take in consideration the dormancy, supply adjusted, or the actually lifespan of coins adjusted by the supply in the course of the time, because obviously 1, 3, 2, 3, 4, 5 years ago there wasn't so much of a supply, so you have to take in consideration that the coin days that could be destroyed, the number of the days, so the dormancy are less because there are less coins. Instead, adjusting by supply, obviously the dormancy are actually we are actually getting out that noise coming from a lot more supply being minted out by miners, and this kind of dormancy. So we are actually taking consideration the weight of the coins itself, the volume of the coins moved on chain. And as you see right here, we are seeing these metrics is just taking into account like 100 coins, 100 more times than one coin. Like if you have the dollars bills like before, we count a $5 bill like 5 and $100 bill as 100, and this is the same right here, and we see this metric decline. So we are seeing a lot of bills being moved, so UTXO being moved, but not much of volume. So maybe they are all $1, for example, bills, okay? And this is also true because we have a confirmation from Bitcoin Days Destroyed right here. You can actually see what is Bitcoin Days right here. So this is getting sideways more than the last bear markets, but still just because of the fact, because this is not supply adjusted. As you see, we are increasing in time from time to time because there are more days, because there are more coins on chain, and this is confirming us that we are still the same level we were before, and we are not seeing so much of a pressure from long-term holders coins being spent on chain. And another thing I want to discuss today, before getting to the point where you can ask me a question and I will respond, is actually this kind of auto waves. So we're seeing that most likely from time to time the short-term holders are more or less at the same levels. Every market, every bull and bear market, they are more or less at the same levels. So there are these red, orange lines, but this green, for example, as declining, maturing. These are 6 month to 1 year coins that are maturing into 1 to 2 year. So not all of those coins that you saw that before are being spent on chain, but actually the majority of them are still on chain and still maturing, okay? And what we are seeing anyway is that not only that, but there are 2 to 3 years people that are actually taking that we saw right here on the realized profit, 2 to 3 years, 3 to 4 years, that are actually selling and taking profit from the older cycle, okay, from the older cycles. Also those right here, but the majority of them comes from 2 to 3 years, taking profit from down here at the 10k level, maybe to actually getting a little bit more of coins, waiting for the price to go down. And when it happens, most likely all the times when these kind of orders that are not actually orders are speculators, because they entered before the bull run and they got just the bull run, they not experienced all the bear market someone experienced right here. So as you see, there is more likely a speculation right here, and they're taking profit, praying to buy low again or just exiting the market to buy bonds, I don't know. Anyway, we can know everything, but we now know that those are those who are selling the most. And 3 to 4 years are actually more or less the same, a little bit of declining because they are maturing into 4 to 8 years. Still taking a little bit of profit, but majority of them, as I already said back here, these are not kind of billions realizing profit on chain. So are very low values and they are not actually meaningful. It's just to make you know what and who is buying or spending their coins actually. And this is 8 years to infinity. Probably this kind of hodling, this kind of court is actually those who lost their money, because in 8 to 9 to 10 years they didn't sold any of their coins. So this is everything I had to say actually. Dominance, DXY, the VIX is still in the bearish sentiment area, more or less at 30. Here we in the S&Ps we reached more or less the first support, and we're waiting for the change of the trend in the daily chart. Probably the S&Ps and the Dow Jones saw their higher low touched before it closed, and the Nasdaq instead, I don't know if it has reached its higher low, is still weaker than obviously the S&Ps and the Dow Jones, but we will see. The dollar is still strong, even if more banks like the Norwegian banks actually are taking rate hikes into account, like the BOE, so the Bank of England, like the Bank of Switzerland, and we are still seeing a diminished pressure in the last few days before the close of the 10 years Japan bonds, but still a lot of pressure weekly on the Japanese yen, because of the Japanese bank just selling Japanese yen to buy bonds and keeping their yield curve control politics in place. So we'll see if this could be that's something that breaks. That could be a snowball effect for the overall economy, as the BOJ or the Bank of Japan just holds more than 1 trillion assets, I think, of the actual US market. But we'll see what happens. So I don't know. Here I explained all the things I actually know, and so if you have any question, anything, probably not. Okay, I'll wait a little bit. If you don't have any question anyway, it's not important. You can always contact me or just saying something to me. I know this time is bearish for you guys and you don't know how to take this kind of thing right here, of this market being bearish, because you have more problems, different problems, and you didn't experience a bearish movement like this. But you should also take in consideration that if you can face this bear market and huddle through, you will have the possibility of a better tomorrow. And I'm saying it for real. This is obviously, I'm not giving you a financial advice, because I'm not a financial advisor and I will never be. I'm just an educator. I'm trying to entertain you, to give you some knowledge about the markets that maybe you don't have, and something like this. And obviously you can also contact a financial advisor if you want. So now that my lowers are okay, I'm saying you should take in consideration that next cycle could be the very best things it could happen into your life, and this bear market is just the moment you could actually change your life for the better. And this is everything I have to say here. So I'm not seeing any questions, so I will just close the actual live stream. This is Chainlog Analyst here, guys. That greets you. Cheers. Have a good day.